For those of us who trade ICT, SMC concepts, a lot of the time we hear it being said online that if there is no raid, there is no trade. For those of us who trade with concepts such as liquidity raids, liquidity sweeps, all of that. Now, the reason that that is important is that if you believe that there needs to be a liquidity sweep before you can take a trade, then it is imperative for you to wait for that liquidity sweep, regardless of what the market does before it has raided that liquidity. A practical example of that is unfolding right now, and I wanted to shed some light on it and why trading can be difficult if you have not put in the reps and built the resilience that is necessary. I'm looking to take a long trade on GBP USD. I'm looking to take that trade from this daily fair value gap outlined here. If you go down to the lower time frame, which is the 15-minute time frame, where I'm going to execute, if I receive the entry signal, what we can see is that for price to tap into the daily fair value gap, this low right here has to be raided. Now, this low, I am waiting for it to get taken out. Today, what do we see the markets doing? The markets traded all the way down after Asia session. During London session, traded all the way down at the start of London kill zone. And at this point, I was pretty sure that price was going to sweep this low and that I was going to potentially take a trade during London session this morning. But what do we see happening? Price, after coming very close, you can see the alert is still there. It has not been triggered. After coming very close to it, has now seemingly begun to rally away from that point. I trade engulfing candles. If I had told myself something like, oh, it has already gotten very close to my area, maybe, some other pair, the liquidity sweep has happened, whatever it is I want to tell myself. When this particular candle printed, because you can see that at this point, price came very close to it. So I was thinking the next candle will take out that low and dip into the fair value gap. Then this candle did this, then this candle did this, then there was a doji, and then this candle did that, then it started going back down again. You can see that price started consolidating just above the fair value gap. Shortly after that, it gave this massive bullish engulfing candle. I would be happy to trade this bullish engulfing candle as long as it happens after this alert has been triggered. Price has taken out the low and tapped into the daily fair value gap. So until that happens, this is not an entry signal for me. Now, for those of us who are familiar with ICT concepts, what we tend to believe is that generally, when price gets to a level that you're anticipating it to clear and starts dancing around there or starts seemingly rejecting from that point without having cleared that level, what is happening is that price is creating relatively equal lows. So relatively equal lows look something like this. You see this? It gives the illusion that that level, that zone is a strong support zone, so that people can start taking early buys away from that level in the form of this 1 hour candle that has seemingly traded bullishly. The essence of waiting for a raid before a trade, as it is discussed in ICT circles, is that what I want to see for me to take a trade is for price. Now, since London kill zone has already ended, is for price during New York kill zone to come back down, take out those equal lows that have been created, and then give me an entry. Then and only then will I execute. It is important to stay patient. If price decides to keep going from where it is, takes off without me, I should not think that I have somehow missed a trading opportunity or that I have failed to make money, because what is required for me to execute and click the buy button has not occurred yet. This is the essence of waiting for your setup and only taking your setup. Now, what would happen is if I take this trade as it is now, because of this short-term bullishness that I'm seeing, I get impatient and I take the trade. If I win it, all well and good. But if I lose that trade, I will be upset with myself. The loss will hurt me more because I know that I could have and that I should have waited for the liquidity sweep. So I'm waiting for it. I just wanted to share this example to shed some insight into why trading can be difficult. You've been waiting for a trade. This is Tuesday, since yesterday, no trade. The market is moving and you want to be part of a trade. You want to execute in the market. It's important to stay patient. Now, it's very possible that price will come back down, take out the low, give me the entry, and that trade will still lose. But if I take a loss to that kind of trade, I am okay taking that loss because that is the sort of loss that has been forecasted and planned and factored into my trading edge. But if I take this trade as it is now and take a loss, that is a loss that I did not need to take according to my rules. The difference between taking losses that go according to your plan and losses that don't go according to your plan is that the losses that go into your plan are factored into your win rate. If you have a 60% win rate, those losses are factored into the 40%. If you now add losses that are outside of that 40% that has been factored, you're negatively skewing your parameters. You're negatively skewing your numbers against yourself. So what should be a 60% win rate might go down to a 50% win rate, might go down to a 45% win rate, and you're negatively impacting your own performance and your own equity curve.